Chapter 10, Part 1, we're going to look at return on investment and residual income. Now, one of the things you need to understand is that we have decentralization, which they delegate, and that describes different types of responsibility centers. Performance evaluation systems are good because they're going to provide feedback to management, but to be effective, they should clearly communicate expectations, provide benchmarks that promote goal congruence and coordination between segments, motivate segment managers, i.e., include the managers in setting up the goals. A lot of times that's not done. Okay, responsibility accounting. Responsibility center, part of an organization whose manager is accountable for planning and controlling activities. Responsibility accounting system evaluating performance of each responsibility center and its manager. Now, there are four types of responsibility centers. One would be a cost center. All they do is collect costs, and a good example of that would be all the costs associated with running the facility. Normally, what they do is collect all these costs and then allocate them based on how much square footage a particular division uses. Revenue center, all they focus on is the revenue, and this might be the sales group. Profit center, they're looking at both revenue and costs. And the investment center is a division where they have not only responsibility for the revenue, the income, but they also have responsibility for the capital. Now, developing performance reports, responsibility center performance reports. Performance reports compare actual revenue and expenses to budgeted figures, variance difference between actual and budget. Favorable causes operating income to be higher than budgeted. Unfavorable makes it lower. Management by exception means we focus on the relatively large areas. Now, segment margin, performance reports are often presented in contribution margin format. Operating income generated by a profit or investment center before subtracting common fixed costs allocated to the center. That's always a big deal because we'll have these big costs that segment managers don't have any control over. And the problem they have is when these resources are allocated, if usage goes down, which may have nothing to do with that department, the average cost goes up. So they may be hit with more costs than they expected and they have no control. So direct fixed expenses are directly associated with the profit center. Common fixed costs cannot be traced to the profit center, and those are the ones they get so upset about. Now let's take a look at return on investment, sales margin, capital turnover, and residual income. Sorry, forgot that one. Now, evaluation of it, this only applies to investment centers where they are responsible for the net income and the assets. Duties of the investment center, similar to the CEO, they're going to look on return on investment and residual income to assess performance. Now, return on investment focuses on profitability by showing how much operating income the division earns on every dollar of sales. So, operating income divided by assets, sales margin, and capital turnover. Return on investment can be broken down between these two factors, operating income divided by sales, which is your sales margin, and capital turnover, which is sales divided by total assets. If you calculate return on investment, so again, sales margin focuses on profitability by showing how much operating income the division earns on every dollar of sales. Capital turnover focuses on how efficiently the division uses its assets to generate sales. So you'll get the same answer if you just divide operating income by total assets. But if you break it down between sales margin and capital turnover, you get a better idea of what that return on investment is. Residual income determines whether the division has created an excess residual income over management's expectations. incorporates targeted rate of return. So it's going to be operating income minus minimal acceptable income. So it's operating income minus total assets times targeted rate of return. Now this is a summary of all these ratios. You can see those in your book. So residual income enhances goal congruence, whereas return on investment may or may not. So now let's look at an example, and we'll go through all of these. So here's our example. We have two divisions. We have their sales, the operating income, and their total assets. So we know we can calculate return on investment and sales margin and turnover and residual income. We can do it all. All right, so what's the rate of return? So return on investment, again, is operating income divided by assets. So for dresses, it's 30%, and for shoes, it's only 8.5%. But it would be nice to know why shoes is so low. Although we can look at this and see it's because they got so many assets compared to how much they generate. But let's go through the process. What is the sales margin for each division? Which is operating income divided by sales. Now, if you look at this, shoes looks a lot better, don't they? They're at 17%, whereas dresses is only at 12%. Now let's look at the capital turnover. Sales divided by total assets. And when we look at this, we'll see that dresses is very efficient based on the amount of assets that have been invested in them and how much it's 2.5 times. Whereas shoes is not very good at all. It's only 0.5. Now let's look at this in the expanded formula, which is sales times capital turnover. So we're going to use it for each division. And what we see is dresses, although their profit margin is not as good, their asset turnover is great, which is why they have such a high return on investment. Remember, you always get the same return on investment when you use the extended formula. It's just you see more information. Now let's look at the residual income. We have operating income minus targeted rate times total assets, and our targeted rate is 21%. So for dresses, we're going to take their assets times 21 minus their operating, operating income, and that tells them they're in excess of 139,680, which is really good. But shoes, no, they're not good at all. They're not even meeting the minimum, which we can always tell based on that rate of return they're showing. So based on the results, only the dress division meets and exceeds the desired return on investment, and the shoe division needs to improve its capital turnover. And again, most companies use average assets and net book value, but depreciation, as it goes on over time, will increase return on investment, which kind of distorts the results. So measurement issues. What balance sheet data should we use? Should we include all assets? Should we use gross or net book value, which we just said? Should we make other adjustments to the income or assets? Limitations. Short-term focus. Potential remedy. Management can measure financial performance using a longer horizon. Incentivize segment managers to think long-term rather than short-term. And that ends this presentation of Chapter 10, Part 1.